it's time that we should start, though I see more and more people joining. So hello everyone, and good evening. Welcome to all of you for joining this session. Thanks for taking the time out and to join this session. I would also like to thank the Institute of Internal Auditors for giving us this platform and for organizing this session on COSO guidance on ESG or sustainability reporting. My name is Puneet. I am a managing director with Protiviti. I lead our risk advisory and internal audit practice for Protiviti in India. Protiviti over the years has played a very key role in developing the original COSO framework. Our global leaders were part of the group which created the COSO framework and have continuously contributed in developing and improving the framework. And the current COSO framework on sustainability reporting also is a domain area where Protiviti has contributed significantly. A quick introduction to Protiviti. We are an advisory firm, global advisory firm based out of 28 plus countries, headquartered in the US. We offer solutions around internal audit, risk advisory, technology consulting, F&A operations. In India, we are a team of 2,800 plus professionals with offices in 7 cities. I am joined by an eminent set of panelists. So I'm joined by Steve. Steve is our managing director from our US office. Thanks, Steve, for taking the time and joining this call. I know this must be really early for you. Steve is our leader for ESG audit practice and has more than 20 years of experience in the internal audit ESG space. Then we have Mr. Anjani Agarwal. Mr. Agarwal has more than 40 years of experience in the consulting domain. He has played a variety of role in the risk advisory, internal audit, strategy, performance improvement, corporate governance. Mr. Agarwal is also on the board and works as an independent director in several large companies. And he's very passionate about the entire topic of ESG, sustainable development, and integrated reporting. I had the pleasure of hearing Mr. Agarwal several times in past. So thanks, Mr. Agarwal, for taking the time and joining the session. I'm sure the practical experience that you have got and the understanding you have got from being on the board and as a stakeholder for the sustainability report which gets published, I think it will be very valuable for all of us here. And then we have Jayanti. Jayanti is a director, leads our ESG practice in India. Jayanti has more than 15 years of experience in the area of sustainability and climate change. And she works extensively with various companies in India and globally in helping them define their sustainability design, helping them in the implementation roadmap, and also then defining the control framework and the testing strategy to make sure that the sustainability numbers and data which gets reported is it has a proper control in place. In the session today, we will broadly have 4 topics. So we'll talk about the significance of the control COSO framework. As you are aware, multiple regulatory bodies, stock exchanges are coming with their requirements on ESG reporting, both in India and globally. In India, SEBI has come out with the BRSR reporting requirement for top 1,000 companies, which is mandatory for the year 22-23. So why this entire COSO framework on sustainability reporting is significant. That's the topic. What are the key highlights of the guidance? Most of the people in the audience today would be from internal audit background. all of us would be aware of the COSO framework for financial reporting and the principle-based approach that COSO framework articulated. We will discuss how that entire framework and the principles have been extended to sustainability reporting, and how can one really apply the framework from a sustainability reporting perspective. We will talk about the ESG reporting more from a India context. Steve will give us a global overview. Then Jayanti will talk more from a India perspective. And then we will discuss how these guidelines can be applied. And we would request Anjani ji to share his perspective in the discussion in terms of what the external stakeholders are looking for and how these frameworks can be applied from a practical perspective. So with that, I would like to hand over to Steve to take the session forward. So we will spend about 35, 40 minutes in the presentation. We have kept 15 minutes towards the end for question and answers. In your screen, towards the right-hand bottom part, you will see a chat box. You can feel free to post your questions during the entire session. And then in the end, we will take up the questions for the Q&A. In case we were not able to answer any questions, we will attempt to publish a document where all the questions will be answered. This entire session is being recorded, and we will also post this entire recording for any future reference. So with that, I'll take a pause. Steve, over to you.
So I wanted to start out by first, covering why is the COSO guidance important and why does all of this matter? So ESG reporting is becoming more common and widespread across organizations around the world. In fact, 90% of the S&P 500 are reporting something, and in many cases, they're using a lot of different standards and frameworks for reporting. In addition, we're at a point now where there is much more increased scrutiny of data. A lot of internal and external stakeholders are looking at this, and as I mentioned before, reporting is widely inconsistent across the board. There's also a lot of higher business to business and other stakeholder pressures that are happening. So even for us as Protiviti, we've seen some of our clients put pressure on us to do more in ESG. So in many ways, what COSO is trying to do is they're trying to provide guidance to standardize practices and decrease the amount of inconsistencies in reporting and stress the importance of internal controls. It's important for COSO in this case to get involved because COSO is highly respected and used by many companies out there as the internal control framework over financial reporting. So we do believe that many companies are going to adopt the same principles to ESG reporting as well. And we're actually seeing that quite a bit around the world right now. On the next slide, so COSO was actually thinking about this over a decade ago. If you remember back to 2013, COSO made some changes to their internal control framework. Can you flip to the next slide? If you recall, one of the changes that they made was actually removing the word financial out of reporting. And the purpose of that change was to broaden their focus on all aspects of reporting, which includes sustainability reporting. On the next slide, take a look at the trends of ESG reporting over the last decade plus. Right, this is just evidence of tremendous growth in ESG reporting and why the COSO board and authors decided to undertake this publication of this guidance. Again, as I mentioned before, it's due to the increased amount of companies that are reporting and the reliance placed by major stakeholders, including institutional investors, customers, and as I mentioned before, business-to-business partners. And we anticipate that over time, this is only going to increase as we look out into the future. On the next slide, a value in an organization is not as easy to measure now, as the majority of the value in an organization is now tied to intangible assets. Many of the ESG components are if you think about it, part of that, right? What is a company doing, for the environment? How are they addressing areas such as employee safety and diversity, equity, inclusion, and other areas that demonstrate their stewardship in the areas of corporate responsibility and citizenship. So because of this increase in intangibles and challenges to carefully value an organization, this makes the world of sustainability reporting even more challenging and increases the need to establish consistent standards. On the next slide, within the COSO guidance, up front, they do state that this guidance is non-authoritative and was created to take the existing COSO internal control framework and then apply it to sustainable business activities. But at the end of the day, like our part of our view is that the guidance is going to serve as the de facto standards, as it does, for evaluating internal controls around financial reporting. Because as I mentioned, the level of respect and usage that the existing framework is already being applied to. So many companies around the world are, taking this guidance already and then applying it to areas such as, greenhouse gas emissions and some of the other, material topics that are out there. And we'll talk about that a little bit later in the presentation. On the next slide, so if you're not aware, in late March, COSO released their guidance on achieving effective internal controls over sustainability reporting. And if you haven't opened it yet, it is a 114-page document. I've shared on this slide, the first page of the table of contents, just so you can see specifically what's in the content. At a very high level within the standards, it covers the reason and the changes going on that are driving the need for this guidance. It discusses the differences between financial reporting and sustainability reporting. And then it goes into each of the 5 components and then the 17 principles with practical insights under each of the 17 principles. And then at the very end, there's an illustrated case. There's actually multiple illustrated cases for both public and private companies and a top takeaways a section for the guidance. On the next slide, here's just a high-level overview of some of the attributes of ESG reporting that differ from financial reporting. First, there is differences in evaluating boundaries. Financial accounting principles defines a consolidated entity and details more specifically on, how to account for many different areas. So depending on, the framework or standards, however, on the flip side, sustainability reporting may be based on different concepts of control or influence. So an example of this would be, some of the complexities around, scope 3 carbon emissions. How far can you evaluate this in your supply chain? And then as regulations and standards evolve over time, alignment may follow. But at this point, there's still a significant, a big difference in this area. Then secondly, sustainability reporting is more qualitative in nature and narrative than quantitative. So it does require a lot of judgment. Many of the disclosures, center, currently around telling a story or showing how you're responsible as a global citizen. And then thirdly, sustainability reporting is more forward-looking and setting targets and commitments than financial reporting, which, traditionally is more historical data. So many of the items also stated within sustainability reporting might be longer term or have a farther, time horizon. So these are 3 things that make sustainability reporting much more different than your traditional financial reporting, and which makes it in many ways very, very difficult to evaluate. On this next slide, so there is, this is just a quick slide of some of the new terms that have emerged over the last few years, which is internal controls around over sustainability reporting, or also known as ICSR, versus the traditional ICFR that we've grown, used to through audit topics, such as Sarbanes-Oxley. So if you hear the term ICSR, now you know, and this is what COSO is addressing in their guidance. Yeah, on the next slide, so the new, COSO guidance does not replace the 2013 internal control framework. It's just guidance on how the 17 principles should be applied to sustainability reporting. And I mentioned this before. On the next slide, it actually reiterates as well the points of focus from the integrated framework and provides more practical insights and guidance on how the points of focus ultimately tie to sustainable activities. So on the next slide, in many ways, people see this as the term, SOXification of ESG reporting. At the end of the day, on the 17 principles, you want to go through and prove out that your ESG program has all 17 principles, and in the term present and functioning, which is something that we saw from 2013. So many organizations right now are doing things like principle mapping. Again, similar to what companies did in 2013, and mapping many of their entity level controls and control activities to the 17 principles. So we'll talk a little bit about that in the rest of the presentation. But many of the activities that your organization might do for Sarbanes-Oxley, or just normal risk management activities, are things that you can easily apply to sustainability reporting. So it might be looking at everything from design and operational effectiveness to performing scoping or risk assessment. On this slide, I wanted to cover, two examples of at least two principles, so you get a little bit more comfortable, with some of the content that's in the guidance. So for this first one, for principle 1, demonstrates commitment to integrity and ethical values. This is making sure your organization establishes a good tone at the top and a culture focused on ethics and principles. So a couple of examples that might help support this principle is whether your organization, signs the United Nations Global Compact or performs, the required actions and annual reporting related to it. CEO letters also are, becoming much more common these days and can demonstrate your organization's commitment to both integrity and ethics. So again, these are just a couple of examples that you can find among others within the guidance. On the next slide, for principle 2, exercises board of directors oversight responsibilities. You want to make sure your organization has proper board oversight of ESG, and that your audit committees have proper oversight of the ESG activities and related risk. So commitments and targets that your organization set, should have some level of board and or audit committee review. And we're seeing this, a lot of organizations make statements like, we want to be net zero by 2030, or we want to donate X amount of money to social justice causes. Again, these are commitments and targets that a lot of organizations are making, and these should, have some level of oversight from the board and the audit committee as well. So again, that's just another example. Just a few other, high-level examples that I did not capture in slides. But if you remember principle 8, assess fraud risk. One of the most common gaps from a decade ago for many organizations was evaluating this principle for their financial reporting control environment. So if you're an organization where ESG metrics ties to compensation, does your organization look at that through a fraud lens? Another example would be, green financing market. It is something that's getting higher in demand. So there is pressure now on shortcuts for those that are issuing green securities, or on the flip side, even more incentives, to play around with data to show that you're in compliance with green financing requirements. So you have to ask your organization, are these activities being carefully assessed? So at some point, your organization should look again to ultimately just map your ESG program to all 17 principles as just one takeaway from this presentation. On the next slide, so if you haven't looked at ESG internal controls, I would say now is a good time for your organization to do that. As we mentioned this already, but many of the lessons and approach used for, Sarbanes-Oxley can be applied to ESG internal controls, where you ultimately, and some of these are just fundamental internal audit skills, right? You determine your objectives, you identify your risk and control activities, and then you ultimately test for both design and operational effectiveness. And then on the next slide, so many companies over the last few years have started putting together risk and control matrices for sustainability reporting and putting more formalization into your controls. So this practical activity of formalizing your ESG controls does ultimately tie to Principle 10, which is selects and develops control activities. But from what I've seen so far, this effort on a global basis is kind of all over the place. Many companies have just started, with a focus initially on, documenting greenhouse gas emissions because of, some of the pending regulation around climate-related risks happening around the world. But some of it has been, some companies have gone out and started, developing much more and kind of gone through multiple material topics. So this is, again, just one of the takeaways that as an organization you can think about. And this is just an example of that. And then on this, next slide, then for all of you, IT folks that are on the line, IT controls should be applied to ESG as well. So another practical, use of the guidance is ultimately don't forget about IT. Over the last few years, we've seen many applications and tools pop up to help organizations manage, the sustainability program. And one thing that more and more people realize is that ESG is typically supported by an entire ecosystem versus a single application. So it is important to make sure that each of your systems are subject to your typical IT general controls. There are tools out there, that are specific for material topics, such as greenhouse gas emissions or human capital management. And then there's other tools out there that are a lot more broad for ESG data management and reporting. So all of these, again, are subject to the typical, change management, security, and operational controls that we ultimately already know about. And again, all of this IT, ties to Principle 11, which is selects and develops general controls over a technology. So again, risk and controls are ultimately much more, are pretty much the same for ESG. So many of you are already experts in this area, but you just need to apply what you already know, again, to specific systems, and then to get to know, some of the, different challenges, unique features, and then even limitations of some of these new applications that have been popping up. So I'll go ahead and pause right there and go ahead and turn it over.
Thank you, Steve. Coming to with respect to ESG reporting in India, where we are, and there has been a lot of developments across the ESG reporting. We started with the very small areas like CSR reporting way back a few years back, and there was BRSR reporting made as voluntary, and then it was made mandatory for certain amount of companies. And now we have the BRSR, the Business Responsibility and Sustainability Reporting, that is mandated for the top 1,000 listed companies in the financial year 22-23. And SEBI has also recently published a proposal regarding the BRSR reporting, where they've talked about looking at the top 250 companies should be looking at a reasonable assurance towards their core BRSR reporting, core mandatory areas. So, and those are like, I'm sure many of you have at least, already publishing BRSR reports, where there are around 9 principles, out of which the principle 2 and 6 is on the environmental, and 4 other principles on the social, and the remaining in the governance areas. So there are a lot of data points that gets published in the mandatory section, and so that brings a lot of trigger to be, bring in these controls within the organization and reporting these numbers in the mandatory sections of the BRSR report. And SEBI is looking forward to make this reasonable assurance, staggered upon over the 3 years, starting with 250 companies the next year and 500 companies by 24-25 and 1,000 more companies to come under reasonable assurance in 25-26. And there are also the disclosures, and they have been talking about the kind of the ESG fund management, the ESG rating providers, and things like that has been the key development. And there are other things like the MOEF comes up with the different compliances which these organizations are looking forward to, whether it is EPR and things like that, which extends to many brand owners and producers, where the data that they publish might be filed within the specific CPCB or the state pollution control boards, but the similar numbers are actually keyed into this SEBI's BRSR report. So it's very essential for organizations to who are publishing their BRSR report to bring in these internal controls with this with alliance, or I would say guidance from the COSO, which is very, very important with respect to the reporting in itself. So giving a background with respect to where do we, many organizations are doing this report. I would say there are first timers, there are mature organizations who have been doing for more than 5 years, 5 to 10 years even. But there is still a lot of confusion in the market with respect to the different type of rating systems, who are the ESG rating providers. So I've just given a gist here in 3 buckets. The first bucket that you see is the different publishing guidance and frameworks. And these are again has developed over the years across geographies. If you look at SASB, has come from the Americas, TCFD from the European regions. Integrated reporting was the very first reporting. These colorful squares are the United Nations Sustainable Development Goals, which was the very initial first step towards the entire ESG in itself. So presently, I will cover up where this is leading up because there is in the market, we are not able to do a apple-to-apple comparison, looking at how these numbers are getting reported by the similar type of industry or organizations. The second 2 buckets are the ESG rating providers. The second bucket are the ESG rating providers who provide ESG rating for an organization, which is confidential and with the direct information, and it is completely on invite, like the DJSI, Bloomberg, CDP. They provide organizations specific questionnaires, and if an investor or your external stakeholder wants to understand your organization's performance, they go to these organizations and find out what is your ESG performance and your ESG score, and what are the risks involved in respect to the ESG. The third bucket are the ESG rating providers who provide ESG rating with respect to the data available in the public domain. So, and these are again, like MSCI was the very first ones to develop this ESG rating or the ESG scores for the organizations. They completely rely upon the publicly available information of the organizations. So the key here is there is a lot of transparent information from the organizations that is getting reported in the public domain in very similar to a financial reporting. So that's the key point here. So as I was saying, being there are so many different standards, so we are almost in COP26 organizations and standards had a discussion around this and have come to an agreement that there needs to be one single global standards. So globally, we will be moving towards a single standard called ISSB, International Sustainability Standards Board, under the IFRS, International Financial Regulatory Standards. So this will mainly focus upon SASB and TCFD, where SASB has 77 different industry type specific standards, and TCFD addresses more from the risk perspective, how the organizations address the risk with respect to the three pillars, E, S, and G. The remaining can be called upon and referred upon as such and complementing this entire standard. So this was expected in December 22. Now it has been postponed and expected end of this month. We hope we can see a trend towards ESG reporting towards one single guidance under ISSB in the coming years. So, and it is important as in your organization, whether you're part of an internal audit committee or your ESG committee in itself, to understand which is this, what are these frameworks are, and what is the index and the contents that goes inside this entire reporting, very similar in fashion to I would say to a financial reporting, because there are a lot of data which is, as Steve mentioned, some are qualitative, some are quantitative data that gets published under these three pillars. So what are the data governance around this area? How are these policies framed, and what are the process and procedures followed, and how the data flows into the final, the numbers that is getting collated, whether it is a quantitative number or else it's a qualitative description around those areas. So all these, each and every, I would say, data points that gets published in these numbers need to tie back with the kind of risk involved in those data points, and then tying back to what are the controls addressing these risks. So this is where it's a key area where the internal audit committee or the ESG committee and the board needs to understand that all the decision making around the kind of the type of reporting, what are the data that we are going to be reporting, what are the key material issues for the organization. So, and how are these key issues are being addressed within the organizations. So I think the internal controls around these areas, this could be the base where, you can start looking at identifying those risks and identifying the internal controls for the same. So where do we look at, in the ESG reporting, again, though the standard could be one, or again, it could be multiple standards that an organization can refer to, but the key material topics to an organization, and that it completely depends upon the type of the industry in itself. Like a financial organization is completely different from a manufacturing industry, where a manufacturing industry might have more environmental footprint. Otherwise, the financial industry might have a more impact or more weightage, I would say, towards the social side of it and governance aspect of it itself. So understanding the overall, the weightage around the E, S, and G is important for the audit committee and as well as the board to know what is your organization's impact and what are the risks involved with respect to these three pillars. So that would be a key area where an audit committee should look at within the organization, and then strategize your ESG overall strategy. Is it in alignment with this, the type of industry where the organization stands? And once that is strategized, you can build out those into an ESG integration within all the existing policies. It's not something completely new. ESG cuts across all the department, all the various process and procedures under different departments, like your health and safety, to human rights, or circular economy, or environmental footprint. Your environmental footprint, where is your complete maintenance activity of your entire electricity consumption to water consumption. All this, each and every area, there is something, every organization has been doing it, and there are policies and procedures around it. And ESG is not something that can run on a silo. It cuts across all these different departments in a very equal way. And there needs to be controls and process and procedures brought in, where who is the SPOC around these areas? How is the reporting mechanism here? What is the KPI inbuilt into these key roles who are playing in these departments, where this ESG KPI or the materiality topics KPI gets inbuilt? Because and the overall governance and the process flow around this area becomes a key area, key important, I would say, a very significant, and the controls have to be developed in these areas, so that each and every decision making around those departments and the SPOCs and the process owners are in alignment to reach the strategy or the vision mission of the entire sustainability initiative of the organization. And it also becomes important to understand whether it is, as I said earlier, there are organizations who are at a very initial stages. There are organizations who are at a more mature stages. So accordingly, and when organizations actually who are starting from scratch, typically in the previous years, I would say last 5-10 years, organization quickly start from, very randomly picking up each and every KPI and working around them and trying to implement around these areas without alignment to the framework or the controls put in place. So it is important now, as we have this COSO guidance, we need to apply the COSO guidance as well as understand the materiality topic and the ESG framework and have a very structured way to approach the entire ESG strategy in itself within the organization. I'll take a pause here and I request Anjali ji to take it up from here.
Hi, good afternoon. So what we've done thus far is understand what this COSO guideline is about and what's the context within India we have. And let me, sort of broaden this. While the COSO guideline talks about internal control over over sustainability reporting, it could as well apply to internal control. And as stakeholders in internal control and governance across organizations, I'm sure the audience is, is a keen stakeholder. Who are the stakeholders? Who are the customers for internal control? So broadly, there are very new types. So traditionally, in the first block, we have the current stakeholders, the usual investors, the stock exchanges, the regulators like SEBI or RBI. You also have the rating agencies, and you have the asset owners for financial services intermediaries. Now, all these stakeholders are looking at ESG data from a completely new lens. And that is a lens of resilience. What is the risk the business is creating on other stakeholders, outside stakeholders, and what is the environment creating, what kind of risks the externalities are there on the business itself. To understand really the resilience of the business, the longevity, and what is a value creation model by the business. So it's a new pair of lens used by the existing stakeholders. For example, let's say in capital allocation, there is a big reallocation of capital going on. More than 80%, 85% of capital providers, financial capital providers, are saying the low emission industry will get increasingly higher allocation to capital, maybe up to 70% as we move towards 2030. Green financing commitments, 85% of the financial providers have said we are committed to 1.5 degree warming or less than that. So they are looking at ESG data from a new lens. So that's how there is a broader, wider context. Next set, the new external stakeholders. So customers are becoming a big stakeholder in the ESG data and hence governance around it. There are enough number of studies reflect that 81%, let's say for customers in a consumer industry, are emotionally bonding with organizations that do the right things. They want to buy from organizations who are doing the right things. People want to join organizations who are doing the right thing. The resource providers are also examining and looking at businesses to say, how are you using the resources? Are you designing out energy, fossil fuel energy? Are you designing out waste? Your supply chain partners are becoming stakeholders in your ESG activities. The government agencies are coming more and more importantly looking at ESG data to see how the business is creating value for all stakeholders. Now the third set, which is the emerging category, and this is really interesting. Now, given that the social disruptions and environment disruptions have been wider, faster, broader, there is a greater awareness being created in the society that the business has, as an organ of the society, has to have aligned goals and shared goals with the social objectives. And hence there is a demand for greater accountability, greater transparency, and also greater relevance as to what the business does for its existence. And the spotlight is really sharper. And the spotlight is being focused on by NGOs, by civil society. There is a rising voice. Social media increasingly interested in ESG data. You heard this data providers and ESG assessors. They're looking at ESG activities and promises and data. There are proxy advisors who are advising stakeholders how to deal with the businesses. So it's like a shared purpose, and everybody, the very wide spectrum of stakeholders are looking at. All of them are external. Now let's look at even internal stakeholders. The employees, the talent. ESG is becoming a absolutely important tool to attract and retain talent. Cross-disciplinary teams within the businesses are using ESG data for decision support system. So here you have a set of customers, stakeholders in the ESG data that are internal. So if you look at this spectrum, there's a very wide spectrum of a very diversified set of stakeholders. They are more demanding. Their expectations are much wider. And with each one of them, set of stakeholders are coming with their own varied interests as to what the business is doing in terms of ESG, which means the proliferation of data that is relevant to ESG, either for decision making or for internal reporting or for external reporting, is extreme and is going to get wider as we speak. Also, what is happening on the information, the financial reporting report was one report, maybe at a quarterly interval that, the listed companies put out at quarterly intervals and then an annual report. But now the communication is again very, very wide to multiple parties at multiple times of the year in multiple formats. For example, a product label being advertised by a consumer product company is again a communication from ESG perspective as to what is the product, what does it contain, what does it do to stakeholders. Your announcements, your advertisements, all of them are part of the whole communication relevant to ESG. And hence, the reason we say this is because internal controls, not only for financial reporting, but any of these communications will be should be subject matter of controls from a ESG perspective. Moving on, now we heard about next slide. Now, so we have an excellent sort of COSO guidance. Now, just to take a pause as to what is the complexity. So just to summarize, ESG data is all about long term. The time horizon, the SDG is 2030, the net zero is 2050, etc., etc. It's a much wider landscape. There are evolving standards. Materiality from both sides is dynamic. The boundaries of reporting have expanded beyond legal control to influence. You heard Steve saying 80+% of valuation of enterprise is in intangibles, and ESG can help unravel that value, how that value is created. We're creating about not only reporting on financial numbers, but also what is the impact being created. A lot of this data will be unstructured, coming from various places. The unit of measurement is not always, in dollar or money rupee terms. So that adds to complexity, and there is a lot of judgment, estimations, assumptions. So ESG has to grapple with it. Now, those are the complexities. Now, how do we use this COSO guideline? Is while it says internal COSO guideline over internal control for ESG, but we can broadly use this in the wider context of ESG. For example, we could sort of shape the thinking process at the top, at the management level, as well as cascading down to ESG data, process owners and risk owners, and data owners to say, what is our purpose? What is our commitment? What are our objectives? What's our strategy? And also shape the culture. So guidance has elements of those points of focus and insights across 17 principles to help sort of educate our internal community. It has a lot of benefits of ESG has been we are sure there are a lot of benefits, but in terms of how value can be created, how it is to be measured, how it is preserved, the COSO guidance has elements of those which can sort of help imbibe the philosophy as well as help being convinced about the benefits of running a very evolved ESG strategy. The COSO mapping, you could do a mapping, COSO mapping of all the entire ESG activities from strategy setting to structuring, running the processes, running the operations, compliances and controls. So that this could help in terms of mapping the ESG activities across the organization, across the 17 principles. The guidance can also help control documentation. There are 17 principles. There is a principle 10, which talks about specifics. So you can leverage this guideline to set those control documentation. There are enough number of illustrative examples in the COSO guideline that can be leveraged. Steve alluded to ITGC. It's very clear that the control activities are neither annual nor manual. It better be run on IT programs, and also leverage the guidance to run a sort of approach, tailored approach. You really calibrate and craft your approach based on an internal assessment of effectiveness first, and then move on to external assurance, move from limited assurance to sort of reasonable assurance. So the guidance has a lot of ways this guidance can be used to really set your ESG program across the organization, not only around internal control over reporting, but as well as internal control per se on running the sustainability program. Next slide. We have top 10 takeaways which are there in the COSO guideline. I'm not going to repeat it. We'll encourage you to run through it.
One second. I would request, since we are now towards the last 10-15 minutes of the discussion, please start posting your questions. We have already received a few, so I would request other participants to also start posting. Right, Anjali, back to you, sir.
No, so we have finished the presentation. I think it should be Q&A time. Happy to take questions, and we would encourage participants to make good use of this guideline and customize to your organization and adapt yourself to adapt the guideline to the organization that you're working with, and really useful. And Protiviti is at help to sort of partner you in that progress whenever you require it. Over to questions.
Thanks a lot. Thank you to all the panel members, Steve, Anjani ji, and Jayanti. It was a very insightful conversation. I will now move on to the questions that have been asked. So the first question is, has any country issued any regulation on ESG? I understand SEC is yet to issue one. As of now, it's more of voluntary and up to the organizations how to disclose. So the question is it still voluntary? Is it mandatory? Has SEC issued any guidance and regulations on this topic? So Steve, over to you from a global perspective, and Jayanti, if you could add from an India perspective.
I would say, here in the United States with the SEC, they issued their, I would say, draft proposal early last year in March. And since then, there's been a lot of delays on when the final rule would come out. And as right now, the final rule is supposed to be, anticipated probably in the October timeframe later this year. So here in the United States, like when it comes down to ESG reporting, a lot of that is still voluntary. But I would say around the world, this is quickly changing. So if you go to the European Union, the CSRD has already been passed, and a lot of organizations now are trying to specifically adopt to that. And specifically, like with that, there's potentially hundreds of metrics out there that are required to be reported. So the reason a lot of companies right now are paying attention to that over in Europe, regardless of whether or not they have any presence or they're headquartered in Europe or have any entities in Europe. The reason it's important to pay attention to that is because there is a lot of requirements there that are going to have a trickle down impact to all of the companies around the world. So like one of the requirements in CSRD is, you need to be able to measure your scope 1, scope 2, and scope 3 emissions. And so scope 3 is obviously a very, very highly difficult, but it's also, I would say, a complex task. So what is end up happening is because there's a lot of business to business relationships that are happening, we're seeing that those data requests are then flowing to some of these private companies or some of these companies that have nothing to do with any business in Europe because of that business to business relationship. So that's just an example of some of the regulations that are happening. Within the Hong Kong exchange as well, there's specific requirements around ESG reporting, and then there's I would say around the world, this is just quickly evolving. But in certain places, it is a requirement already, and then in other places, such as the United States, it's not necessarily a requirement yet. But we will most likely get there sometime in the very near future.
Puneet, you're on mute.
Yeah, sorry. So Jayanti, over to you from India to.
So I think I mentioned, yes, Puneet. I think I did mention SEBI has made mandatory on this BRSR reporting, though it is not called as an ESG reporting. It is very much a detailed ESG reporting divided under 3 sections, and the third section has around 9 principles, which is divided among the 3 pillars E, S, and G. And there are mandatory and voluntary sections in this entire reporting, which is very, very detailed with respect to any GRA reporting or a SASB reporting. So it is, again, the top 1,000 lists are mandated to publish it in this financial year 22-23. Having said that, as a guidance in the Middle East, yes, most of the countries, the stock exchanges have published their guidances with respect to which is the ESG reporting, and they are requested all the listed organizations within the stock exchanges to start reporting their ESG reporting and giving guidelines across either it is a SASB or more on GRA reporting in the Middle East. So the guidances have been published there, and as I said, the mandatory one is the BRSR for the top 1,000 listed in India.
Right. Yes, Anjali.
I'll just supplement what has been said. From an India perspective, we should not think that we are going to lag behind the Western world in terms of ESG reporting. We are in fact doing a faster than necessary fast forward catch up. That's point number 1. 2, most of the US and European companies, large companies, are operating in India. So whenever they apply there, soon enough, simultaneously, we will have to respond to those needs. Third is, even if there is a company that does not operate in India, if we are a business partner to that company, then soon enough, under scope 3, we will have to follow through. So our advice is we should not presume that the applicability to India will come later. India has taken a very fast forward approach. You would have seen in net zero goal setting, India is pretty much in tandem with, in fact, ahead of you in the Western world as well. And so we should be in tandem, if not faster than necessary. I don't see a reason why we will lag behind in terms of making that applicability. The regulators here are some of the best regulators that we have anywhere in the world.
Thank you. Thank you. There is some follow-up request for the presentation. So after this webinar, we are going to share the presentation with all the participants, and also we will post the video of this webinar on our website. We will also, there have been requests for additional details in terms of what country-wise, what regulations. So we will try and compile some of that information and share with the participants who may like to have them. So question around what are the regulations in Europe, what are the regulations in other countries. So we'll try and share some more knowledge content on that particular topic. Moving on, there is a question in terms of what is the role that internal auditors can play in the ESG space. So Anjali ji, if you would like to take on that question.
A good question, whoever has asked. I think ESG is of topical interest to all businesses, very relevant. Yes, it is evolving. So what role internal auditor can play is it depends on many things. In terms of cricket analogy, you could be a player, you could be a coach, and then you could be an umpire. Now, internal auditors typically are used to a third line of defense. So internal auditors are have a competency to spot what's not working and then help close that gap. However, since this subject is relatively new and still evolving, both in terms of standards, in terms of the aspirations that the businesses themselves are going to have, and they are also crafting their purpose, their objective, their roadmap, their transition plan, their long term. My suggestion has been to let the internal auditors be a part of the game, be more in second line rather than wait to be in third line of defense. So that will be a recommendation. That also helps internal auditors community to engage, play the game, understand the nuances. It's a very new subject, relatively moving parts, evolving subject, evolving regulations. So be a part of it rather than be on the sideline and then hope to review what has been done by somebody else. So be a process owner to start with. That will give you a lot of satisfaction, a lot of insight, and also a lot of competence building, capacity building yourselves to deal with the ESG subject and sustainability.
Just to add to what Anjali ji said, I think with SEBI proposing a reasonable level of assurance for the top companies, I think this is going to go in the direction of SOX or IFC from an Indian perspective, where one will need to have proper risk and control on the reporting which is happening around ESG. So for some companies, it will become mandatory. For other companies, though it will be voluntary, but the stakeholders will expect that there is some reasonable level of assurance, and that's in the domain of internal audit and IFC control. And hence it will be important that internal auditors start looking at that area and maybe to begin with build that as part of the internal audit program for the year 23-24. Moving on to the next question, two related question. For the companies where ESG is still voluntary, for private companies and smaller companies, what is the benefit from adopting ESG? And would the management expect return on investment for ESG related investment? Anjali ji, I'll pass this question again to you. I have heard you speak on this topic before, so I'll just pass it back to you.
Okay. Okay. If so that was the question. And if the hidden question is why ESG for organizations who are not, for whom it is not mandatory. So let me respond to that if that is really the hidden purpose behind the question. Now, sustainability is good for business. Now, all ESG does is put it into three buckets. One is the environmental side, resources, environment, natural resources. Middle bucket is all about social relationships, etc. Third is governance. So if you accept that business operates under the overall economy, wider economy, and the economy works within the envelope, bigger envelope of environment, then one should accept that the existence for the reason for business should be increasingly whether the business is producing products or services that are relevant to people and planet and society. So that's the wider context of purpose. And if you accept that businesses that are meeting these objectives will have longevity, will have resilience, will be creating value for themselves only when they create value for external stakeholders. And earlier in my talk, I alluded to how the set of stakeholders is expanding in all directions. So there is a spotlight. Businesses are not, for example, if businesses are not mindful of the fact that we as a set of human beings consume within 7 months what our Mother Earth is able to regenerate over 12 months, then if businesses are not conscious to that, they are wasting resources. Some of these natural resources come free, but there is an increasing focus on natural resources accounting. There's increased focus on how are you creating relationships around the 6 capitals, etc. So increasingly businesses, public or private, will be under a sharp spotlight to see how are they creating value for the wider spectrum of stakeholders. Now, if you believe that, then you would rather evaluate what is your goal, what's your ESG strategy, how do you around both all the three pillars of E, S, and G. So regulatory reporting or not, it makes great sense for businesses, private, public, government, or otherwise, to make sure we have a sound sustainability strategy, repurpose ourselves, and move in that direction. I hope I've sort of philosophically answered the question, and happy to chat more.
Is there ROI on ESG investment?
Yes. If 84 Standard Poor studies and more studies reflect, and there is no doubt about it, is 85% or more of the value of an enterprise is in intangibles. Now, how do you create? So we talk about ROCE, ROE on the financial capital. And when the questioner asks, is that an ROE or ROI? They're talking about investments on the financial capital invested. But more and more, actually the business uses natural capital, relationship capital, intellectual capital, social capital, and there is more spotlight as to how you're using these capitals, what are you doing, and how are you increasing value on these capitals. So if you broaden the capital definition beyond the financial capital only to all these sets of capital, then you will see that ESG actually can be a multi-bagger or a value multiplier. So there is no doubt about it. And more and more. For example, there is a global business alliance of 2,000 top companies who have clearly said success of business is in measured in terms of what it contributes to the world. So if you measure the return on investment that you have made and include the return to all the stakeholders around all these capitals, then you will see that ESG will be definitely will have always a positive return.
Steve, you wanted to add something?
Yeah, and I also just wanted to be respectful of time, so I'll just give my 20-second point of view on this. But for private unlisted companies, as I mentioned before, it's going to impact you anyways, regardless of whether you like ESG or not, because of the business-to-business impact. But there is a potential for increased revenue because customers like ESG. And then here in the United States, like a lot of organizations are looking at using ESG and sustainability reporting to decrease costs as well. We're seeing a lot of companies, look at and become better stewards of things like water and electricity. So some of these projects have a tangible ROI on it. And then the other factor that's a huge deal is just making your employees happy. Like we mentioned it, like a lot of employees in the labor market now, they want to work for companies that align with their personal values, such as, social justice causes or environmental change. So if you can use that to maintain your employees, that keeps your labor costs a lot lower than needing to replace them, because your organization can be a revolving door of employees that are leaving because of the fact that you don't embrace some of these concepts within ESG.
Thank you, Steve. I'll take last question, just in the interest of time. Like I said, we will publish a note after some time, a few days after this webinar, and we'll try and answer more questions in our note. Last question, back to you, Steve. Are we seeing any unified standards or unified institution coming up which will bring some standardization to this entire ESG reporting at a country level and maybe even a global level? And today, are external auditors required to certify ESG reporting and issue any adverse opinion if there is any wrong reporting? So how do you see this evolving in next couple of years?
So there's two parts to that question. The first part is just how is ESG evolving from a standard standpoint? And one of the biggest complaints around ESG has always been there's just too many frameworks. There's not consistencies out there. And I do think that over time and we're already seeing this, there's been a lot of consolidation of some of these larger ESG frameworks and organizations, as we mentioned in our presentation. So I do think that you're probably still gonna be dealing with a whole different frameworks and different standards and things like that. But over time, you're gonna see some level of consolidation, which I think will ideally make it a little bit easier for a lot of organizations to adopt. And then the second question, I think, was around assurance providers. And so far, mostly around the world, we see a lot of organizations go out and hire, these either big four companies or some of these niche firms to come out and give some level of limited assurance. And some of these limited assurance might be more around greenhouse gas emissions or diversity, metrics as two of the more common ones. But traditionally in these areas, whenever these limited assurance, opinions come into play, a lot of the procedures have been more substantive in nature. They're just looking at the completeness and accuracy of data to be able to back that up. But right now, as we're seeing a lot of the regulations and just expectations move towards limited and then eventual, reasonable assurance, this is where I do think that more and more organizations are, needing to put in these controls in place, because once we get to a level of reasonable assurance, and there's going to be some merging of sustainability reporting with financial reporting, reviews, this is where the focus on internal controls is going to be required. requirement. And that's part of the reason a lot of organizations like right now are putting together risk and control matrices and doing so in coordination with their external audit provider.
Thank you, Steve. So with this, we will close the webinar. Thanks a lot to all the participants. Thank you for asking all the interesting questions. I know we have not been able to answer all of them. There are several more which are there. We will try and respond to them over a period of time. There is a lot of content that you can find on this topic on the Protiviti website. You can also visit our knowledge portal called Protiviti knowledgeleader.com. Reach out to us if you would like to have a subscription to Knowledge Leader, where you can get lot more content around this topic. Also, thank to all the panel members. Steve, thanks for taking up this meeting at such early hours. Thank you, Anjani ji, for spending this time with us, and thanks, Jayanti, for sharing your insights on this topic. Thanks a lot. With that, we will close this meeting.
Thank you. Delighted to be here. Thank you. Bye-bye.
Thank you, everyone. Bye-bye.
All the best in the ESG journey.